So let us go straight to our market mavens, and let me get some help on the floor for sound, because I'm kind of cut off right now. Here now is CNBC contributor Keith McCullough of Hedgeye Risk Management, CNBC contributor Don Luskin of Trend Macro, and Lee Munson, Chief Investment Officer at Portfolio Asset Management. Assuming that I can possibly hear you, and I'm not sure I can, I'm a great lip reader. Don Luskin, let me ask you about Mr. Jeffrey Immelt, okay? Is he the guy to give us a corporate tax cut? He is now part officially. He's running this Jobs Recovery Council, the new pro-business Obama 2.0 with Bill Daley. Do you have confidence that Mr. Immelt will deliver a corporate tax cut?
No, I don't, Larry. Because I don't hear him talking a lot about it. If it was an important priority to him, we'd hear it in the headlines. It's just not happening. The reality is that executives like that can offer good advice and counsel to presidents, but the advice they ought to give is the one they never have the courage to give. They ought to give the president the same advice that John Galt gave the president in Atlas Shrugged, which is, get the hell out of my way.
I like the John Galt thing very much, but Lee Munson, I want to ask you the same question. In his op-ed piece today in the Washington Post, I mean, we have a lot of market stuff to do, but Washington matters a lot. He did mention a competitive tax code, that is Mr. Immelt. I want to ask you the same thing. Is something changing now? I know trust but verify, but this looks like the new Obama 2.0, pro-business, deregulation, limited government, and putting another big business guy in there. You've got Daley, now you've got Jeff Immelt. Lee, does that matter to your investment strategy?
Well, you know, it does, and I'd say that I love that Don mentioned Ayn Rand, and that's an important part of my life, but here's the thing. What we're doing is we're putting lipstick on a pig. But here's the thing. If you put lipstick on a pig long enough, it will start to look good. So I don't really care if the president really wants to have pro-business people in here, if that's really his thing. The point is, if every day he starts flip-flopping and flopping over to the pro-business side, I think that's going to make it look that way. And so I think if we just root for him right now and don't worry about what his real intentions or trying to be a political person, let's just be happy that he's inserting some people. The outcomes, neither me, Don, or you know. I just like that they're trying to pretty up the situation.
I like that.
So I think it's a positive.
No, I think that's a great point. Keith McCullough, I want to round out our panel. Get your take on this story. Is this the new pro-business Obama? Is a corporate tax cut alive?
I'm not sure on the corporate tax goods side, but certainly having a guy like Immelt who has the credibility of the business community and who has a handshake that actually means something internationally, I think that's a very good step in the right direction. I think what we're going to need to see, though, is the strength in the dollar be reestablished by both the credibility of that handshake and really start to see it in the marketplace. Of course, this week, as you saw, this week was not a good week for the dollar, Larry. You also know that I'm long the dollar, but it's been down 3 of the last 4 weeks, which is disconcerting.
Well, stay with me on that.
Yeah, but Keith, why you got to give me an argument of why that dollar is going to get stronger. I want to believe you, Keith. I'd love to be long the dollar right now, but give me something other than contagion is over in Europe and Immelt's going to, you know, make a good PR slogan.
Well, I mean, that kind of sounds like something my broker would have asked me. But at the end of the day, I mean, what I really want to see is an effectively strong U.S. balance sheet, strong currency, and a strong credibility position in the business community, not only domestically, but internationally. And that's basically what I need to see.
Well, wait a second. You know, let's not be too hard on the euros. First of all, the currency has gone up a lot. Don Luskin, I think we have a chart. European stocks have had a heck of a new year from top to bottom. I think Spain led the parade with a 10% increase. Yep. They are rising across the board. There's the euro itself is now up to $1.36, which is incredible. And I think we can show the stock market they've had a great run. Now, that's got to be a good thing. In fact, some of them are talking about having the governments actually buying back some of the bonds cheap. What do you make of that, Don? Is the euro story now improving to the point where we don't have to worry about it in the U.S.?
Hard to believe, isn't it? There can actually be virtuous cycles in our world, not just the vicious cycles. It's become so easy and so fashionable to talk about for the last 3 years. What we're seeing now in Europe is a virtuous cycle where a little bit of improvement and growth, a little bit higher inflation, starts making it easy for these countries to roll their debt. So we start seeing just out-of-control countries like Spain and Portugal able to go back to credit markets, and all of of a sudden everything starts getting better. When everything starts getting better, then it becomes even easier for them to go back to credit markets. Now, there's another thing going on under the surface, which is a little less pleasant, and that is that all the big banks in Germany and France and the UK have been gradually and quietly but measurably liquidating their positions in PIGS sovereign debt and PIGS bank exposure. And that's actually good, because that means that if the wheels do come off, if there is a shock, if anything that goes wrong, it won't be a systemic shock that will take down the big banks in Germany and France, which could touch the big banks in the U.S. So it's
yeah, but
getting
you think
better.
that's going to help 25%, up? Because I know, Don, I mean, you're on my good side because it's Friday and you mentioned Ayn Rand, but do you think that that problem is really going to allow this overly optimistic, the S&P is going to be 25% up, if you're saying that we still have some problems with these banks selling their positions?
I didn't say we still have any problems with those banks selling their positions. All that has to happen for my view of the S&P to gain 25% in 2011 is for some big disaster not to happen. I don't require any brilliant thing happen anywhere. All that we have to have is not have one of these tired old bearish scenarios that I've been hearing out of people like you for 3 years come true. And they're obviously all going in the wrong direction for that. So everything's looking good.
Well, all right, Keith McCullough, let me bring you back in here. U.S. stocks rising, European stocks rising, but emerging market stocks are falling. From China to India, throughout Asia, they've got inflation problems. They're tightening monetary policy and interest rates. Same with Brazil, same with Chile. In other words, U.S. up, Europe up, emerging markets down. Now, what does that mean? Is that a new trend? And might that virus come back to haunt us here in the States?
Yeah, the global macro risk management setup definitely changed this week, Larry. Emerging market stocks got absolutely crushed. And the one thing that crushes emerging markets is obviously inflation. It also hurts bond markets, and I do see that in the bond market. The bond market does not act well. There's a variety of issues in the bond market that we could talk about. But at the end of the day, inflation really hurt these international equity markets. You had India actually trade down to -7% now for the year to date. Indonesia's down 9%. China had 2-3% down days this week. So this thing's shaking a little bit. And by the way, the Russell 2000 here in the U.S. was down 4.2% on the week as well. So you saw that in small caps in the U.S.
What does that mean, that the small caps, they have been leading the way? What does that mean? Follow through on that point for us.
Well, I think the speculative nature of the momentum trade, which was certainly running a little rampant, particularly in the last couple weeks, and after the kind of December that we saw, that shouldn't be a huge conceptual surprise. But we saw 4.2% drawdown in small caps this week, and I can guarantee you anybody who's running any measurable level of risk across any kind of market cap structure that they felt that this week.
So there's a little bit of a risk-off trade is what you're saying. That's very interesting. Don Luskin, let me come back to you. The banks, supposed to lead the market, but they're really not leading the market. They delivered very mixed earnings. B of A, not so good. Citi, not so good. J.P. Morgan, very good. What do you make of the bank story? Is that going to be an impediment to the stock market or not?
Let's just say that it's not going to be a help. But this is something that I've been saying on this show for, I guess it's practically years now. We just cannot count on the banks to be any kind of growth story. At best, they are a back-from-the-dead recovery story. That's the kind of thing we're seeing in bank earnings this week. What we are seeing nakedly exposed, that you cannot count on them as a long-term growth play. And the good news is that banks are falling off the radar in terms of growth expectations. At year-end, 40% of expected forward S&P 500 growth was supposed to come from the financial sector. It's now down to only 30%, because as they recover, as their expected forward earnings get realized and turned into trailing earnings, they become less and less important to the market as a whole as a forward-looking growth story. We're outgrowing the banks. We do not need them to lead us anymore, which is great because they can't do it.
So you're still optimistic. You're holding your bull position. Is that correct?
Oh, absolutely.
All right, Lee Munson, I want to ask you about the drop in gold. 2-month low. It's about $100. I think it has to do with the fact that the end of the world is not really happening. But I want to ask you, where do you go from here? You and I have jousted a bit about the gold story. What's your take now? You buy it back at a 2-month low, about $100, or not?
You know, I knew you were going to bring this up to me, Larry, because, I told you off air that you're right. We were going long gold a couple weeks ago.
I would never have divulged that. I would never, have divulged that. The fact that I got something right one time in a row, I would never have said that, but thank you for saying it.
Well, you are right. Now, I'll tell you why. I do think that a lot of what is happening right here is we're questioning whether or not the fiat currencies are really going to be dead. All of my statistical models, and that's why I was trying to press Keith to give me a credible story of why we think the dollar is going to get strengthened, because I want to hear it from Keith. I respect him. But if I was long or short gold right now, I would exit the trade. I'm not neutral. I'm saying exit the trade, and I'll tell you why. It's starting to slope technically, and for those people who out there who really want a reason for why things trade, I may not be able to tell you anything other than we're starting to question whether fiat currency is really that much of a danger. People are starting to question whether or not the dollar is going to strengthen right here. So we're at a tipping point where you just can't be in that trade right now until we get more clarity. But I would tell you that if I saw gold go down 100, 200 an ounce, today, right now, I would not necessarily buy it back unless we saw gold really start to stabilize and the dollar
I want to give you the last, because we're having some trouble with the control room and all the rest of it. Keith, just last one. If Washington policies look better, lower tax rates, maybe less spending, maybe having Mr. Immelt in the mix is a good thing. What about the Fed? You still got easy money from the Fed. Where do you come out? What's your best trade right now?
Long the dollar if the Fed starts to lean a little bit more hawkish, because that would be good for the dollar and good for interest rates.
All right, we're going to leave it there, gentlemen. Thank you very much. Keith McCullough, Don Luskin, and Lee Munson.